The Minority Market. Episode 40. Expectancy, Probability, and Edge in Decision-Making. Most people approach the stock market with a dangerous belief that success comes from being right most of the time. They believe if they can predict price direction accurately, profits will automatically follow. This is one of the biggest misunderstandings in market participation. The minority does not focus on being right. The minority focuses on expectancy, probability, and building an edge. This shift in thinking is what separates gambling behavior from professional decision-making. Let us begin with expectancy. Expectancy is the mathematical expectation of your trading or investing behavior over a large number of actions. It is not about one trade, one investment, or one lucky move. It is about what happens when the same process is repeated hundreds of times. A positive expectancy means that, over time, your actions generate growth. A negative expectancy means that no matter how good you feel after a few wins, the long-term outcome will be loss. The market does not reward excitement. It rewards repeatable processes that create statistical advantage. Probability is the second pillar. Every decision in the market is based on uncertainty. You never know what the next candle will do. You never know how news will be interpreted. You never know when institutions will shift capital. The majority tries to eliminate uncertainty by seeking predictions. The minority accepts uncertainty and works with probabilities. They understand that each setup, each opportunity, and each investment has a probability of success and failure. They do not expect certainty. They expect ranges of outcomes. This is where edge comes in. An edge is simply a condition or method that slightly increases your probability of favorable outcomes over unfavorable ones. It does not need to be perfect. It does not need to win every time. Even a small advantage, when combined with discipline and repetition, becomes powerful over time. The minority builds simple, understandable edges and executes them consistently instead of constantly changing strategies. Imagine flipping a bias coin. If the coin gives you heads 55% of the time instead of 50%, that small difference may not feel important in 10 flips. But in 1,000 flips, the advantage becomes visible. The market works the same way. Small edges, compounded through repetition, create large differences in results. The majority keeps switching coins. The minority keeps flipping the same biased coin with discipline. One of the biggest mistakes beginners make is evaluating performance emotionally. They judge success by short-term profits and losses. The minority evaluates performance by process quality. Did you follow your rules? Did you control risk? Did you execute according to your plan? These questions matter more than whether a single trade ended in profit or loss. Long-term success is built on consistency, not emotional satisfaction. Risk and reward also play a major role in expectancy. Many people focus only on win rate. They want to win often. But winning often does not guarantee profitability. If you make small gains and take large losses, your expectancy becomes negative even with a high win rate. The minority understands that risk-reward structure is as important as probability. They design decisions where losses are controlled and gains have room to grow. Another critical element is sample size. One trade proves nothing. 10 trades prove little. Only after many repeated decisions does your true performance emerge. The majority changes strategy after every loss. The minority understands variance and allows their edge time to play out. They know that short-term randomness does not invalidate long-term logic. Emotion is the enemy of expectancy thinking. Fear causes premature exits. Greed causes oversized positions. Overconfidence causes rule breaking. All of these reduce your statistical advantage. The minority protects their edge by protecting their behavior. Discipline is not about willpower. It is about building systems that make correct behavior easier and emotional behavior harder. Let's bring this into a practical mindset. Before entering any position, ask yourself 3 questions. First, do I understand the probability of success for this setup or decision? Second, is my potential reward worth the risk I am taking? Third, am I following my predefined rules? If even one of these answers is unclear, the minority chooses to wait. Waiting is not inactivity. Waiting is part of disciplined execution. Expectancy also applies to long-term investing. Choosing quality businesses, allocating capital wisely, reinvesting gains, and avoiding emotional reactions all build positive expectancy over years. The minority investor does not chase hot trends. They focus on building a portfolio that benefits from time, compounding, and structural advantages. Another powerful concept is accepting losses as operational costs. Losses are not failures. They are expenses paid to participate in the market. The minority budgets losses into their system. They do not emotionally react to them. They simply execute the next decision according to plan. This mindset creates stability and emotional resilience. When you truly understand expectancy and probability, your relationship with the market changes. You stop chasing certainty. You stop reacting impulsively. You stop feeling desperate to be right. Instead, you become process-focused, calm, structured, patient. You begin to think like an operator of a long-term system instead of a gambler chasing outcomes. Over time, this mindset compounds. Your decisions become cleaner. Your emotions become quieter. Your confidence becomes rooted in preparation, not prediction. This is the mental shift that creates durability in markets. Remember this clearly. The minority does not win because they predict better. They win because they manage probability better. They survive because they protect their edge. They grow because they repeat disciplined actions without emotional interference. If you want to step into the minority, start training your mind to think in probabilities, not predictions. Build small edges. Protect capital. Follow rules. Repeat the process. Let time and consistency work for you instead of against you. This is not exciting. It is not glamorous, but it is powerful. And this is how real market participants build lasting success.